Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us, we have Jeff Schulze. He's Head of Economic and Market Strategy at ClearBridge Investments. We're going to talk about some potential shifts in the macro environment as momentum might be moving around here. Jeff, it's great to see you as always back in studio with us at Nasdaq. Let's talk about divergent consensus outlooks. We're talking about earnings acceleration. We're talking about declining economic backdrop. How do these reconcile each other with the back half of the year?
Well, first, thank you for having me on the program here. Yeah, right now there's an expectations for a reacceleration of earnings in the back half of the year for the S&P 500, but that stands in stark contrast to economists' forecasts for the economy, with nominal GDP expected to be cut in half, going from 7 to 3.5%. So obviously one of these two cohorts seem to be wrong. And we think ultimately that the markets are pricing in a too optimistic outlook as we're anticipating a recession over the next 3 quarters.
Let's talk about some of those indicators from the ClearBridge Recession Risk Dashboard. How does that support the view that the economy could be heading for a recession the back half of the year?
So our proprietary Recession Risk Dashboard is a group of 12 variables that have historically foreshadowed a durable bottom. Stoplight analogy where green is expansion, yellow is caution, and red is recession. And at the moment, out of those 12 variables, 10 are red, 2 are yellow, and 0 are green. And when you look back at the last 8 recessions, this is historically the output that you see as that recession materializes. Maybe more importantly, over the dashboard's history, we've only had 9 red colors. 8 of them have turned into a recession, and the only false positive was way back in 1967 when the economy was basically at a standstill.
It's interesting you say that because as long as I've been covering the risk dashboard, I do not recall seeing 10 indicators, so that kind of stuck out to me as well. In a paper you recently published, you talk about a soft landing where rolling sector recessions might offset weakness in other sectors. How likely is this outcome for a soft landing scenario?
Well, I know it gets a lot of airplay with the strength that you've seen out of housing, but I think it's important to remember that almost every recession looks like a rolling recession. The only synchronized downturn that we've ever seen was 2020 when the economy literally shut down. Usually it's housing first to turn down, then it's durable goods, then non-durable goods, and eventually services and employment. And the fact that we have seen some housing resilience shouldn't be a surprise, because usually you will see a bounce or some resilience in some of the sectors that move down even before recession materializes. But I think importantly, you can have a housing sector that maintains momentum even with a recession. We saw that in 2001. So while it's possible, we don't ascribe it a high probability.
I mean, the housing sector, it's all based on supply and the lack of inventory, which seems like a little bit more of a special situation. Then you have higher rates. I mean, how many home buyers are locked in 4% or lower? There's just no inventory moving.
Which is why we're not expecting big declines from housing prices. You've seen some resilience over the last couple of months. But if you look at mortgage applications, you look at existing sales, not painting as rosy as the picture as what you saw with housing starts last month.
Yeah. What warning signs should investors be aware of should we get this shift in economic momentum?
Well, I think the canary in the coal mine from our vantage point is initial jobless claims. It's one of the top 3 variables in our dashboard. Usually when it turns red, it coincides with the start of a recession. Importantly, right now it's yellow, and you've seen initial jobless claims move down over the last couple of months. But if this does move up into the high 200,000 range, we think that that's a point when the recession will materialize. And I think maybe more importantly, yes, you've had some resilience in economic activity in the first half of the year, but over the last 8 recessions, 3 quarters prior to the start of a recession, real GDP growth is 4.5%, 2 quarters prior, 3.5%, but more importantly, 1 quarter prior it drops to 0.8%. So you usually see a very sharp deceleration as you head into a recession.
How should investors be thinking about positioning into the remainder of 2023?
Well, we think that quality makes a lot of sense here. We like dividend growers in particular. Dividend growers were expensive coming into the year, and they've gotten a lot cheaper as investors have moved into more cyclical parts of the market and your mega cap tech stocks and AI beneficiaries. But if we are going to have a recession and earnings expectations are not what they seem to be, we think that investors will flock to dividend growers because they have strong balance sheets, they don't need to tap the capital markets, and they have a high degree of earnings visibility, which is an attribute that investors covet. And lastly, if the Fed does need to hike more because inflation is sticky, that rising dividend growth will help negate the effects of duration.
All right, Jeff, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.